And he teaches at both Indiana University and Loyola University, I believe, or at least has, and well, I'm sure. And for many years, he was director of education at the Options Institute of Cboe. And he toured and gave talks here in North Carolina and elsewhere. And some of our members still remember those. So with that, I will hand it over to Russell.
Sure, thanks, Don. Actually, I left Loyola for Indiana.
Okay.
So yeah,
I'm glad to have that correction.
I think if I was trying to do both of those things, work at EQD, and that would just be the end of me. So now I joined the Kelley School of Business. Gosh, we're in our second week here, and I'm going back and forth to Chicago because I have two high school daughters, and heaven forbid that I ruin their lives anymore by having them move. So. And I'm in my office here. I'm going to talk about two different things tonight. I'm going to talk about VIX fairly quickly and just how VIX behaves into expiration. And this may be something that I talked about I think it was almost a decade ago that I saw you guys. But just talk about something that I have been consistently trading and doing okay with for some time. You know, if any questions come up along these lines, did I ever do video for CME on options? Steve, I have not done a video for CME, but I am working on some white papers on how to use options on futures. So maybe when those come out, because those are open to everybody, I'll send Don a link and he can share them with everybody. I'm also doing white papers on, I'm working with a lot of exchanges now. It's kind of nice. Instead of just working for Cboe and focusing on Cboe stuff, I get to focus on Nasdaq and options on futures, and even one Asian exchange and one European exchange as well. So I have not done anything in some time for CME. I did a few things when I was at Tab Group, but I don't think really anything that I get all excited about. And again, anytime people, if you got a question, throw it in the box. I'm more than happy to address the questions. Now, just a quick look at VIX and the relationship between VIX and VIX futures. There is no fair value relationship between spot VIX and VIX futures. If you can figure out how to replicate spot VIX in a portfolio, tell me, and I will, tell me how to do it, and I'll take 5% of the profits to run the whole thing for you, and we'll still both buy islands. When I was at Cboe, I'd get called into trading firms, and they were, it was always a one-way conversation where they were just trying to get as much information out of me as possible. But it was very apparent that a lot of really smart people have tried to figure out how to replicate VIX in a portfolio. And as far as I can tell, nobody's figured it out quite yet. If I had, I wouldn't share that because that would be the brass ring behind making money. Now, the futures, they trade at a discount or premium, and it really is based on a market outlook. Typically, the futures are at a little bit of a premium. This is my stock. Here's what the term structure should look like academically as we go out farther. The futures contracts do. Oh, yeah, that would help. That would help, wouldn't it? You'd think that I'd never done this before. How about that? Sorry, guys. There we go. All right. I basically read these to you. You don't have to have me read those again. And then I was showing my the chart that I use when I write books or whatever that just shows you the term structure. And this is typically how the term structure looks. The farther out we go, the slightly higher the VIX futures. The relationship that most people like to focus in on is month 1 and month 2, mainly because that's the majority of the volume, but also if you get involved in the VIX ETPs, those are the 2 futures contracts that everybody's concentrating on as well. Now, the thing with respect to VIX futures is they do gravitate toward the spot VIX price as expiration approaches. And what I did years ago, and I continue to update this, and I continue to trade it. I trade it, and then I update it, and then I compare how did my trading do relative to what the model says. I do that about every 6 to 12 months just to see how things are going. And basically what I did initially was I took a look at the VIX futures contracts and selling them short certain number of days before expiration, and then covering the short the day before expiration. And when I would do live presentations and I'd start talking about AM settlement, I would often ask everybody in the room who's been burned by AM settlement. I'd raise my hand. A lot of other people would raise their hand as well. So I do like to cover the short the day before expiration. And for full disclosure, keep in mind that when I first started doing these presentations, I worked for Cboe, and I was trying to put things out there that maybe increase the volume a little bit, but also wanted to avoid some of the criticism around VIX, which really is associated with the settlement. A lot of people question the settlement process sometimes. So as you can see, I've updated this fairly recently. And what I took in these negative numbers on the second column, that total points, that is a positive if you're selling short. So don't let the red numbers scare you off too much. And from January 2007 to July 2021, using the standard monthly futures contracts, I took a look at what if you sold short on the close anytime between 2 to 9 days to expiration, and then again covered that short on the close the day before expiration. And you can see that VIX was lower, about 2/3 of the time, and we got some really nice down moves. Those maximum up moves, which is the second to last column, those are bad up moves. If you're short the VIX futures, those are pretty painful numbers, and I'm going to get into what I do to avoid a $15,000 loss, which is what would happen if you were short the VIX future there with 3 days to expiration. On average, you're looking at 40 to 60 cent move to the downside over these numbers. Now, the philosophy behind all of this is, and I know I'm going backwards, is that the future will gravitate towards spot. Well, you don't necessarily want to sell short when the spot VIX is at a premium relative to the future. So I screen things out. Only do this when the spot VIX is at a discount to the front month futures contract. And you can see the total points, those numbers do come down a little bit, but what I really do focus in on here is that maximum up move, and I think at some point, all of us that are involved in the markets learn to focus maybe even more on the potential losses than the potential gains. And the maximum up moves dropping from, I'm going to go back and forth real quick so you can see the difference, dropping from 10 points, 15 points to 5 or 6 points, that makes this a lot more attractive to me. And the one that I really do like to concentrate on, and the one that I've been trading for maybe since I saw you guys 10 years ago, is this 4 days to expiration. And on a standard expiration cycle without any holidays in there, that would be the Thursday the week before expiration. These are trading days. So if in a couple of weeks, when it's the Thursday before VIX expiration week, I'll take a look at putting on the short position, and I will get out of the short position on the Tuesday before Wednesday AM settlement. And I've stuck with the 4-day thing for years now, and it seems to have worked out fairly well. Now, 4 days in expiration, as I mentioned, I said that's today, and that just happens to be that I'm using a slide from last month, where I happened to be doing a presentation on the Thursday before expiration. So what I talked about was shorting the August future on the close and then covering the short the following Tuesday, again, the day before AM settlement. But I don't like to do this with the futures contracts. I like to do this with options. For those of you that are relatively new to VIX, you may not be aware that the VIX option contracts, the best underlying pricing vehicle for VIX options is the corresponding VIX futures contract. And as one of the first things that I teach when I teach derivatives at now I guess Indiana, is the most you can lose when you buy an option is the premium that you paid for that option. And that's always something that gives me some comfort when I've got one of these positions on. So what I do is I look for a somewhat deep in the money put option, not terribly deep, but one that maybe has a time value of somewhere in the, I don't know, in the 5 to 15 cent range, and purchase one of those as opposed to shorting the futures contracts. And what I'm showing here, these are actually prices from last month on that Thursday with the various put strikes. I think these were midday, and with spot VIX at 1617 and the August future at 1745. Here's the offer prices for all the puts between the 20 and 25 strike. And you can see like the break even for the 23 strike is 1730. It's the same for the 24 and the 25 strike. Once that break even starts to be the same number, that's usually the option that I'll choose to purchase. So I did buy the 23 strike put. I know that VIX rallied a little bit in August, so it wasn't the best of trades, but you know, this was the trade that I actually put on, and this break even relative to VIX, that $1.13, that is what the profit would be pretty much if VIX didn't move at all between the Thursday to Tuesday. But as the futures contract drifts down to the spot VIX. The 23 is what I purchased. And I really like this payoff diagram where I get to put VIX in that area of if it doesn't move at all, we're going to make a little bit of a profit. What I actually did in addition to this, I think on Friday, I might have sold the 17 put or something like that. The one discretionary thing that I will do is I will buy an in the money put, and then as we get like buy the 23 put, need to look at my statement and see exactly what I did. But then as Friday starts to go along, maybe about midday on Friday or so, I'll take a look at possibly selling another put option just to take in a little bit of premium and cover some of that time value as well. So this end. Don mentioned that there was somebody that may be trading this. Is there anybody that heard me talk about this before that is still trading it? And for some reason, I can't find the.
I want to identify the person in case they're.
Okay. No, I just they can send me a private message as well. I do know that. No, I mean there's certain events that I do on a regular basis, and I've talked about this before. And there's always 2 or 3 people that have stuck with this, and I like to see that some of my work is helping some people out there. I'm not selling anything or anything like that. I just enjoy talking about the markets and. Coming up with consistent ways that maybe the little guy can compete with the big guy. So basically, VIX futures, they gravitate to that spot index, consistently shorting into expiration. It's worked in the past, and personally, I like buying an in the money put that would be profitable if VIX does not move at all. One other thing that I have done that still has a little bit more risk, but it's not as risky as being naked short the VIX futures contracts, which I just really do not, I really discourage people from doing that. We see what VIX can do if we get some sort of a surprise overnight or surprise over the weekend. And I feel like we should always have some sort of cap on being short VIX. But one other thing that I have done in the past is taken a look at doing calendar spreads where maybe you short August and own September. And that has worked fairly well, and it's dampened the damage somewhat, but I feel like the buying the put has been the better methodology behind this. So any questions on VIX? Because I'm going to switch over to NASDAQ, to index options and NASDAQ in a moment. Okay, I took a long drink of water. Now, did you distribute the presentation that I showed you?
No, I did not know that you wanted that.
All right, well, good. Then I'm going to go ahead and switch presentations. Because there's
absolutely
there's just a better, I just came across a better presentation with respect to a systematic approach to trading NDX options using VOLQ. And let me make sure I've got the right one up here. It's not this one, it's this one, or it's, I believe, I apologize. I came across this like at 6:22. So I was like, I'd rather talk about this. So
sure.
Okay. And I'm gonna, let me switch so you guys see a full page, and don't worry about that. So this is an old Interactive Brokers presentation that I did. So I'm doing some consulting work with Nasdaq, and what I'm getting ready to show you actually works using Russell 2000 index options with the Russell 2000 Volatility Index. It also works in a roundabout way using SPX with VIX. So, you know, if you don't trade NDX, this also works with the Qs. I've got a college student that saw this presentation and said, "Can I trade it with the Q options?" I'm like, absolutely. So I'm not going to talk too much about what the NASDAQ index is, but I want to talk about VOLQ and then a methodology that I came up with using VOLQ to kind of dictate how we go about doing a trade. So VOLQ is like VIX, but not exactly like VIX. It's a 30-day measure of implied volatility, but it uses just at the money, slightly in the money, and basically slightly in the money and slightly out of the money calls and puts to come up with a 30-day expected volatility measure. And by using at the money option contracts, it actually is a bit more of an accurate indicator with respect to the subsequent realized volatility than VIX is. And I mentioned a couple of white papers. I do have one on VOLQ coming out maybe Friday, but definitely early next week, that touches on what I'm going to talk about today and some other things. And again, I'll just send a copy of that and have it distributed to the group if that's okay. That way you guys don't have to sign up through some firewall and give your email address to get a copy.
Oh, that'd be great. Thank you.
So, and I'm happy to distribute it like that. So this is just the behavior of VOLQ versus NDX. If I did not put what markets they were and I asked everybody to say, what is this? I would probably get a lot of that's the S&P 500 versus VIX, but it is it's not the S&P 500 versus VIX. It's the VOLQ versus the Nasdaq-100. They have that same inverse relationship that we all expect out of a volatility index. So what I'm going to talk about today is buying a 3-month strangle and selling weekly strangles and using VOLQ to dictate the different strike prices. And this is like a consistent methodology that I have been trading for a while now. So in order to convert VOLQ to a 5-day forecast, which is, I like to use trading days when I do these sorts of things, just take VOLQ, divide it by 100, and multiply it by the square root of 5 over 252. In fact, I just have an Excel spreadsheet that I put in, where's NASDAQ and where's VOLQ, and it gives me an upside and a downside, gives me upside and downside moves. So back on August 7th, the last year, VOLQ was at 2568. That gives me a 1 standard deviation move over the next 5 days of up or down 3.62%. VOLQ is definitely at lower levels now. And this means with NDX at 11,139, I'd take a look at if this is the strangle that I'm selling, I'd look at selling the 10,725 put and selling the 11,550 call. Now, at the same time, I would, at the same time, I have a 3-month I'm long a 3-month strangle. And I did this on June 19th, 2020. That's actually a standard option expiration date. I was doing the strangles using standard option expiration dates for the back testing. There's a little bit of an adjustment that I'll do every once in a while, and I'll talk about that as I go through as I go through the methodology here. So VOLQ, 63 days, that's basically assuming 21 trading days a month. That gives me up or down 13.81%. So back on June 19th, I would, the 1 standard deviation strangle involved buying the 8,600 put and buying the 11,400 call. And those are very wide strike prices relative to where NDX was at the time. A couple of reasons that I'm buying the strangle and then selling the strangle. One is just for protective purposes. Again, I never do anything that's naked short options in addition to being naked short VIX. Theoretically, they're kind of the same thing if you think about it. So what I would do is I would own this strangle over the 3-month period and keep selling a 1 standard deviation 5-day strangle against it over and over and over again. And so like the first time that I put a trade on, it was on June 19th. I, again, bought this strangle, and that cost me 294 points. And then I sold the 9625 put and sold the 10,400 call. Were you getting ready to chime in for a sec? Okay, I just thought I heard a voice. So this is the whole scorecard behind me doing this starting in June and holding it through September. In one of my mantras with respect to systematic trading is that the system is always smarter than I am. I have deviated away from that now. And you can see that the long strangle started to deteriorate in value. And what I'm doing here, I took in the short put, took in the short call premium. We've got the running short strangle P&L, had a couple of losses in here. Actually started to regret what I was doing for the first few weeks, but I had tested this over several years and I felt like it would work itself out in time. And you can see that eventually I was making money on these short strangles over and over and over again, and it started to add up and offset the time decay that I was experiencing in the long strangle. Now I did get a big move around August 28th, and I stuck with the system, but I will tell you when this has happened since then, if I have something like 700, a net almost 700 point gain in this, I'm taking it off. And then I'm looking 3 months out or so and starting over again. I'm very good at following the rules of systematic approaches, and the rules behind what I'm showing you right now work fairly well. But if I get a big outlier move like I did August 28th that week, I will be taking off the long strangle and then maybe buying a strangle. I'd probably look at the standard November expiration at that point. So I have added some subjectivity into this when we get a big outlier move. And I also, where is this one? Yeah, this was a same time period in 2019 when we didn't have a whole lot of volatility. And this is normally how I expect this to work. On June 21st of 2019, and this is a paper trade. This is real trade. Whoops. This one was real trade. This was back testing paper trade. And you can see that the back testing paper trade, I might have gotten up to 100 points or so each time I tested it. If I see a 500 or 600 point gain, again, I'm taking that thing off instead of holding it through the whole system. But it works when we get big volatility moves. It tends to work when we have low volatility as well. And it's just kind of a nice systematic approach to try to take advantage of time decay and not get run over by the overall markets. So some of the other alternatives, using longer dated options for the long strangle, I have found that Wednesday options seem to be overpriced a little bit more than Friday options. So I'm looking at the short strangle being Wednesday to Wednesday, as opposed to Friday to Friday. But again, exiting the strangle if there's a big market move, and also exiting before expiration and going ahead and maybe salvaging things and rolling into some longer dated options are some things that I have done as well with respect to this approach. So those are the two approaches I wanted to talk about tonight. Are there any other questions you guys want to throw at me or anything else? I know I feel like I went fairly quickly, quicker than I expected.
Okay, so that's great. Oh, hang on.
Whoops.
Sorry about that.
Sorry, Don, I went ahead and muted you.
Was somebody trying to ask a question in there? They want to type it? I do not. Do I ever use VVX? And that is a. See, Jack, this is exactly why I do these type of things. I have never thought about using VVIX to trade VIX options. Let me write that down. So the answer is I do not use VVIX in any strategy. What I do use VVIX for is VVIX is a great leading indicator with respect to where VIX is going. When you see VVIX tend to hold up and VIX is starting to grind lower, I take that as an indication that folks are still stepping up and buying out of the money VIX call options, because that's what drives VVIX. So my feeling is that until we see VVIX maybe confirm VIX settling into lower levels, that you want to be a little bit cautious with respect to the overall markets. But I have never thought, and I don't know why I've never thought of that. But if I come up with something really good with VVIX dictating the strike prices for VIX options, I will report back on that.
Russell, where do you think we are today with VVIX kind of tapering off a little bit this afternoon? And, we got a couple weeks left in the current cycle, and it seems like there's quite a bit of premium built into the futures.
The thing with VVIX kind of remaining above 100, which is that kind of line in the sand that I always kind of take a look at. I do know that there are some institutions that have been coming in and periodically buying calls, but they're looking at the October and November timeframe right now. So that might, in October, will feed into the VVIX calculation. That may be the time period that we want to be a little bit concerned about with respect to what I refer to as our next volatility event. We used to have Cboe actually has a where they break out the front month and the second month options for VIX, or at least they used to. And I'd love to see something like that with VVIX. For the, I got a question with the typical trade size. This one, it depends on how expensive the initial strangle is. How's that? I'm trying to find that. Right in here, I did a 4 lot to keep it under about 10 points, or I'm sorry, to keep it under 1,000 points. So this one I was doing as a 4 lot. If I had traded this, where the premiums were much lower, probably would have done this. I'm just trying to back into. Might have done this as a 10 lot. Think about it. Yes, the slides will be available, and I'm actually going to make a few adjustments and put together one deck for you guys and send it over. So that'll get distributed after this, because I changed what I was initially going to do. VOLQ is somewhat similar to VIX, but it doesn't use as many option contracts as VIX. VIX is calculated using 2 strips of SPX options. So at any time, there can be between 150 and 300 options feeding into the VIX calculation. VOLQ uses 4 expirations, 2 just before and 2 just after the 30-day time frame. I think it either uses 8 or 16 options, but VOLQ is very much of an at-the-money measure of Nasdaq implied volatility, whereas VIX is a measure of implied volatility that incorporates the whole strip of options. So VIX is generally elevated relative to the subsequent realized volatility, because you're including those out-of-the-money put options that have elevated implied volatility relative to at-the-money options. If you want to do the NDX trade on RUT, RVX would be the equivalent, and SPX, it would be use VIX. I'm using VOLQ instead of VXN. Let me find something real quick, and I'll show why. I apologize, but let me see. Where's my white paper? There it is. All right, this has not been published yet. But I want to show a graphic from here. And so right here, this is VOLQ versus NDX and VIX versus SPX. The correlation is a little bit greater with the realized volatility, but these 2 numbers right here, the 2 bottom numbers, VOLQ is greater than realized about 62% of the time. VIX is greater than realized almost 80% of the time. So if you think about using VIX in the same way that I'm talking about using VOLQ, you're going to take in less premium because your strike prices are going to be farther out. VXN, because it uses a strip of options versus VOLQ, it would most likely be overpriced in the same way. So that's why I use VOLQ over VXN. But you can see that just the index is a little bit more accurate with respect to the realized, and the average difference of the index versus the realized. VOLQ on average is overpriced by 31.19%, and VIX is overpriced by over 37%. So when I use VIX for these sorts of things, I actually make a small adjustment Is there a comparable at the money vol measure to VOLQ for RUT and SPX? I'd have to look into that. I know that there are some volatility indexes out there that will use ETF option pricing, like the IWM option pricing and the SPY option pricing. So there may be, but it's not popping. It's not coming to mind right off the bat. But I can check into that. Scott Nations is the person that's really the mind behind VOLQ, and he has tons of volatility indexes. So I would not be the least bit surprised if he's got something like that. Also, I don't talk about this publicly because I try to stick with data that is publicly available, but Bloomberg does have a consistent 30-day at the money implied volatility measure that you can download if you have access to a Bloomberg. Most people do not have access to a Bloomberg, but if you do, you may want to take a look at that 30-day at the money implied volatility measure. There's also a 10-day at the money implied volatility measure that you can utilize in the same way. But I stick with VOLQ and VIX because we can all get hold of that data. I think the worst thing in the world is I could sit here and talk about something that you can't replicate on your own. There's a white paper on the Nasdaq site that talks about the VOLQ method. I did not write that one, but I'll bet you that if you go to, and I'm going to type this, I just put Scott Nation's website because he has done so much. I mean, he's basically the creator behind VOLQ. I have a funny feeling that the kind of documentation that you might be looking for might be found on Scott Nation's site. But what I'll also do is I talk to the NASDAQ folks frequently. I'll find out if they moved that paper somewhere else or what may have happened to it. Let's see, there's white paper. I tried that this year in the middle using 1-year NDX strangle and selling weekly strangle, but yeah, I liked, there's a comment in the chat, tried using a 1-year NDX strangle. I like using the quarterly one. Just I think what ends up happening if you use 1 year, you go so far out on the strike prices that you might get whipsawed around enough that you'll lose money on the short strangles and you won't benefit from the long strangle. I didn't test longer dated long strangles versus 3 months. And that's why, yeah, so that's why I just stuck with the 3-month one. I never tested anything longer data. Maybe I should have. And I got the VOLQ equivalent for SPX and RUT. There might be, as I mentioned before, but not one that pops in my mind. And you're asking about a recording of what I've just talked about, or something else?
Well, we'll look after the recording, and it'll be we'll post in anywhere that you saw this. You'll see the recording posted.
Okay. Annual return on the methodology. I would have to. I'm having a fairly decent year, but I do about 4 different things within my account, and I'm in the middle of the June to September right now. After I roll the long trade out, either when we get to September expiration or before then, I'll see how things have been working. But I got to break all of that out. I haven't gotten creamed. How's that? Yeah, that's probably the biggest non-answer you guys have ever gotten. So, any other questions?
Well, let me ask one while people are perhaps asking, putting their heads together or thinking about a question. the strategies you've outlined assume an inefficiency of pricing, I think. And of course, that's always not necessarily.
Well, I mean, options are frequently overpriced relative to, the subsequent realized volatility. And selling options over a long period of time, you are going to end up making a profit. There are instances where you're going to get completely run over, and I guess the philosophy behind everything that I'm trying to do is take advantage of that overpricing of options and make sure that I don't get absolutely, and make sure that I'm around when we have a like a March of 2020 type of situation.
So does that perpetual advantage that has been there for so long, is it an inefficiency?
Yeah, I would say I don't necessarily refer to it as an inefficiency, just more of being able to take advantage of an edge in the marketplace that not everybody can take advantage of. You have to keep in mind that most people are not allowed to sell short options naked without some sort of hedge in place, which I think is what they're precluding a lot of people from being able to be naked short options. I think that's part of the reason that the options continue to be slightly overpriced. One of the neat things that we've experienced with all the new traders that have come into the marketplace, they've all been buying options. And anybody that's been involved in the option market for more than a year or two knows that consistently only buying options is not a methodology that's going to result in profitability. And I was saying that for years when I was with Cboe, when I was doing a presentation in Boston, and somebody came up to me after the presentation, and the guy was a engineering professor at MIT. And he came up with a way where the day before expiration, he's buying a whole bunch of straddles, and he's got like a 5% win rate, but the 2 or 3 straddles that he wins on the day before, the 1-day trades offset all those small losses. So that just sounds like too much effort to make money in my mind.
Super. I think a couple of other people have put in questions now.
Oh, let's see. Oh, God. I have not looked at, I haven't looked at the VLab site in a long time. And these are all that just send me links to a bunch of other volatility indices. No, I haven't really looked at those I'm just seeing if there's any of these indexes. No, I haven't really looked at either of these. Yeah, and like Don said, although I've dodged the last 2 questions, I'm happy to try to answer anything you guys throw at me. I need to go to the Stern site more often.
So the market is becoming less efficient rather than more. We have all these long side only option people coming in.
I think it's just I think it's just consistently. Well, after we have volatility events, I do believe that we are less efficient for some time. But that less efficient state usually goes away within a few months. I know that I just said that the increase in retail folks for individual stock options, I think, has jacked up the implied volatility and created opportunities for option sellers in those spaces. But broad-based index volatility sellers, they've learned that after we have a volatility event like we did back in March of last year, that's really the time that you don't want to go to the sidelines. If anything, that's when you want to start sizing yourself up. And the assets under management for a lot of the short volatility hedge funds actually increased after after we got those spikes in volatility, because they had kind of trained their clients to say this is the time that you need to add more money.
Do you believe in a general theory of regimes of
Yes.
volatility?
Absolutely. But the high volatility regimes are becoming shorter than they were in the past, and we've just seen that. I like to look at the commitment of traders report with the VIX futures contracts, and take a look at are we net long or net short with respect to VIX futures as far as the speculative money goes. Typically, when we get the volatility event like we had, the pros actually go net long. They didn't go net long VIX futures this time around.
So they're getting more sophisticated?
I think they have. In fact, here's there it is. Yeah, this is. You guys can still see my screen.
Yes.
This top chart is this is the Volmageddon. And when this blue line is above 0%, that means that we're net short. I like to have the higher line as the speculative money is net short, and then right around in here, after Volmageddon, you can see that they went to net long for a short period of time. This is what happened with COVID. And you can see the zero line is down here at the bottom. So the institutions stayed net short VIX futures, and they lowered their short position. They probably got squeezed out of a lot of them. But in my position with EQDerivatives, I talked to volatility managers, and one of the better ones that I like to talk to said that if anything, in March, they were seeing inflows into their short volatility strategy. And as they put it, we really did train our clients to know this was going to happen at some point. And when it happens, that's the time to maybe add money. And I believe across a handful of managers, that's why we did not see a repeat of a pattern that we've seen in the past, where we get the volatility event, hedge funds or speculative money, which is how it's, I think it's how it's referred to in the COT data, doesn't go from short to long as a net group. And they didn't this past time around. Do I see a product like XIV coming back? There's a product like XIV that is in front of the SEC, and they're having a hard time getting it approved right now. But it's like XIV, but it's got a better stopgap measure. I would like to see a product like XIV come back, but unfortunately, the SEC seems very skittish of a lot of things these days.
Are these contract-based vehicles inherently flawed?
Not necessarily. I mean, you could say that about options, because so many options expire out of the money, and people would make that same argument about options. I don't think they're necessarily fraudulent, because they're very straightforward with respect to what they are. And I think it was TVIX. It even said I remember in the prospectus, verbatim, it was almost, you should not buy and hold this product. It was more of a trading vehicle. And when I would talk about the volatility ETPs, I would always say that you need to approach them with the same mentality that you approach buying an out of the money option, buying them out of the money call or put option. If you get some movement in the direction that you're hoping, you're still going to lose money. You've really got to get a substantial move in the direction that you're hoping in order to really make money off of the long ETPs.
That's right, but I'm thinking also of the breakdown. Didn't one or two of the ETPs go completely bankrupt, or were they manipulated? And there was talk of people waiting until after the close or this kind of stuff to to finally make their move, and people tied to these sponsors of the vehicle? Are these vehicles suspect?
I don't think, I know that the sponsor of XIV was fully hedged, but they were hedged with over-the-counter products. So they weren't really the ones that were involved in in the actual trading of XIV after hours like that. It was other ARB firms that were always trying to trade the difference between the two. We had a question about when we get a big old, do you exit expiry? Why do I exit the long expiry on a vol spike? What I actually would do is I'd take profits on that and roll out to a longer dated long strangle. So I would, I would kind of cash out and start over if I get a big outlier move. Instead of just, and the way that I tested this thing was just using 3-month standard expirations versus weeklies. But I've seen a couple of instances where we got a really big move, and the long strangle was a big profit, and just felt like it was probably not such a bad idea to roll out. If the Nasdaq sold off 5 or 10% early next week, I would probably take off the I know I would take off the long September strangle and probably go out to December at this point. Ooh, and yeah, somebody mentioned UVXY is still out there. Do I see any bankruptcy risks for VXX? I don't. I mean, Barclays needs to have a rogue trader that puts them out of business or something like that. And I do know that because I've sat on the desk, it's been many years, but I do know that Barclays, their exposure to VXX is consistently hedged. But the thing is, Myron, the thing is, if let's say that a 2008 type of situation repeats itself, and instead of Lehman Brothers, it's Barclays that goes out of business. Well, if you owned VXX because you saw the storm clouds gathering and you knew the big volatility spike was coming, it's very possible that if Barclays is the one that goes bankrupt, that you are in line with the other creditors. So that risk is there, but I think it's very, very minuscule.
Are broken wing butterflies broken? Is that trade? A lot of people who are in the community, in the open community on the internet for options traders, have historically traded broken wing butterfly trades. And some people came to the conclusion that that trade is now broken. Would you agree with that? Or? I
am an absolutely awful subjective trader. I know it. I'm very good at coming up with a systematic approach and doing my very best to stick with it. And the broken wing butterfly, that strategy was something that Jim Bittman, who was one of my mentors, developed and would talk about an awful lot. And are you talking about the broken wing butterfly where if the market moves in one direction, you switch it over to a vertical spread, and if it moves in another direction, maybe you flip it over to 2 vertical spreads?
Somebody else would be better able to summarize it, but I think there's a variety of variations of it.
He would do very well with that, but then about once a month, because he was doing it with weekly options, about once a month you go, oh my God, I rebalanced at the very worst moment. Yeah. And I know myself well enough to know that if I were in a similar trade, that I would probably rebalance at terrible moments. Also, I've got my consulting job. I teach here at Indiana. I don't get to watch the markets nearly as much as I used to. So I'm not really keeping an eye. I know what I'm supposed to do. I've got a calendar that tells me when I'm supposed to check in on things. And I just kind of let the systematic approaches do what they are supposed to do.
I agree with you.
Yeah. There was a question about that I skipped over, and I apologize. Indicators that might indicate an upcoming spike in VIX other than VVIX. I like the 3-month VIX as a leading indicator for VIX. It's, in fact, I did a obscurely published academic paper that with Professor Larissa Ademiak, who took my job at Loyola, actually, where we talk about how combining the 3-month VIX and VIX together is a better model at predicting volatility spikes and future volatility than VIX by itself. So I always am looking at the relationship. Plus, a lot of people like to look at the VIX curve. And the thing with the VIX curve is you've got to do a lot of adjusting with respect to the days to expiration. Whereas if you use the 1-month VIX versus the 3-month VIX, there are consistent timeframes in there, and it's a good history that you can work with.
Do you have any books coming up? I know one of your recent books was, what was it? The handbook, right? The options handbook.
Did that, and I did write a newer one on VIX. Yeah, the VIX handbook. The fun part of that book was really doing the history of the volatility events, and just some of the things that were going on leading up to them, and how the markets behaved coming out of them. I don't have another volatility book coming out. I might have a Warren Buffett related book coming out. I wrote the study guide for the Warren Buffett way, and there's something I want to do that I don't think anybody else has done with respect to Buffett, and I don't want to say it because the last time that I said a book that I wanted to work on, somebody stole it, and I'm still smarting over that one because I talked about it with an editor, and then I saw a version of the book on Amazon, and guess who the editor was? I won't be working with those guys again. VIX, the 9-day VIX, one of the difficult, somebody just asked about VIX 9-day. One of the difficult things about the 9-day VIX is the weekend impact on implied volatility. On Friday this week, we'll see a little bit of extra headwind for VIX because we're coming up on a 3-day weekend. It's even more dramatic with the 9-day VIX. So that short time frame is very difficult to work with and compare it to the other consistent measures.
Fantastic. Thank you. We shouldn't keep you too long because, as you've said, as you've demonstrated so many times, you're extremely generous with your time.
Oh, not a problem at all. You guys have given me some things to think about, and it used to be you could walk around the financial district in Chicago and bump into somebody at the bar and start talking about this stuff. I don't have that opportunity anymore. So doing things like this is very good for me. It keeps me sharp-ish.
Thank you so much. And we will have a recording. We will have the material if you wish to send it to us.
Yeah. I'll break some things out and put one document together for you.
Fantastic.
Okay.
Thank you very much. We really appreciate it.
You bet. All right. I will do the stop share.
Okay. Thank you, and have a great trip there.
All right. Thanks. Myron said something very nice. I appreciate that. Thank you. Thanks a lot.